Hello and welcome. So, you've done your homework. You've learned about the S&P 500, you understand what ETFs are, and you're genuinely excited to start investing your money. But now you're staring at the final, and let's be honest, the most daunting question of all, okay? How do I actually put this all together? How do you take all these individual pieces of information and build a complete, diversified portfolio that's actually right for you? The sheer amount of information out there can be paralyzing. Should you buy 10 different funds? Maybe just one. What percentage should go where? It feels like you're trying to build IKEA furniture, but they forgot to include the instructions. Well, consider this video your instruction manual. This is a practical, step-by-step guide to building your very first investment portfolio. There's no complex math, no confusing jargon, just a clear, actionable blueprint you can literally implement today. Let's get building. First things first, let's talk about the foundation. Before we even think about picking a single investment, we need to build on solid ground. That ground is your personal investor profile. This profile has two key components: your time horizon and your risk tolerance. First up, time horizon. This is simply the length of time you expect to keep your money invested before you need to pull it out and use it. We can break it down into two main categories. Long-term is anything over 10 years. This is for big, far-off goals like retirement. With a long time horizon, you can afford to take on more risk because your portfolio has plenty of time to recover from any market downturns along the way. Then there's short-term, which is less than 5 years. This is for goals like saving for a down payment on a house. For short-term goals, you really can't afford much risk at all because a sudden market crash could devastate your savings right when you need them most. For the purpose of this guide, we are laser-focused on building a long-term retirement portfolio. The second part of your profile is your risk tolerance. This is your personal, emotional ability to handle the inevitable ups and downs of the market without panicking and selling everything at the worst possible time. And you have to be brutally honest with yourself here. If the thought of a 20% drop in your portfolio's value would keep you up at night, it's a sign you have a low risk tolerance. On the other hand, if you can see that same 20% drop as a potential buying opportunity, a stock market on sale moment, then you likely have a higher risk tolerance. These two factors, your time horizon and your risk tolerance, are going to determine the single most important decision for your entire portfolio, your stock and bond split. Now, let's move on to the simple blueprint. I have great news for you. You do not need a complicated portfolio with dozens of funds to be a successful investor. In fact, some of the most effective portfolios are the simplest. We're going to use the legendary 3-fund portfolio as our blueprint. This portfolio was popularized by the Bogleheads community, a group of investors who follow the principles of Vanguard's founder, Jack Bogle, and it gives you instant, global diversification with just 3 simple funds. Fund number 1 is a total U.S. stock market fund. Think of this as your core holding for the entire U.S. economy. This single fund holds thousands of U.S. companies, from the giants you know like Apple and Microsoft, all the way down to smaller, up-and-coming companies. Popular examples of this are Vanguard's VTI or iShares ETOT. Fund number 2 is a total international stock market fund. This is your passport to global growth. It invests in thousands of companies from both developed and emerging markets outside of the United States. We're talking about huge global players like Nestle, Toyota, and Samsung. Great examples here are Vanguard's VXUS or iShares IXIS. And finally, fund number 3 is a total U.S. bond market fund. This is the anchor of stability in your portfolio. It holds thousands of U.S. government bonds and high-quality corporate bonds. Its job is to provide some income and, more importantly, reduce the overall volatility of your portfolio, acting as a cushion when the stock market gets rocky. Common examples are Vanguard's BND or iShares AGG. And that's it. Seriously, with just those 3 ETFs, you own a small piece of nearly the entire global stock and bond market. It's simple, it's incredibly low cost, and it is brutally effective for the long run. Okay, let's get to the fun part, the step-by-step assembly guide. Now we're going to put it all together. Step number 1, determine your stock and bond split. As we said, this is your most important strategic decision. A very common rule of thumb to get you started is the 110 minus your age rule. This helps you figure out your stock allocation. For example, a 25-year-old might do 110 minus 25, which equals 85. So, their portfolio would be 85% stocks and 15% bonds. A 45-year-old might do 110 minus 45, for a split of 65% stocks and 35% bonds. Now, remember, this is just a starting point. You need to adjust it based on your personal risk tolerance. If you know you're more conservative, you can dial back that stock percentage. If you're more aggressive, you can dial it up a bit. Step 2. Divide your stocks between US and international. Now that you know your total stock percentage, you need to decide how much goes to the US and how much goes overseas. A common and well-researched split is to put somewhere between 20 to 40% of your stock allocation into international funds. For our example today, we'll use a simple and effective 60-40th split, meaning 60% of our stock portion will go to US stocks and 40% will go to international stocks. Step 3. Calculate your exact percentages. Let's build a sample portfolio for a 30-year-old with a moderate risk tolerance. First, the stock A bond split. Using our rule, 110 minus 30 equals 80. So, we're aiming for 80% stocks and 20% bonds. Now let's calculate the US stock allocation. We take that 80% stock portion and multiply it by 60%, which gives us 48% of the total portfolio in a US stock fund like VTI. Next, the international stock allocation. We take our 80% stock portion and multiply it by 40%, which gives us 30% of the total portfolio in an international fund like VXUS. And finally, the bond allocation is simply the remaining 20% of the portfolio, which will go into a bond fund like BND. So, the final portfolio looks like this: 48% in VTI, the total US stock market; 32% in VXUS, the total international stock market; and 20% in BND, the total US bond market. See how easy that was? You now have a globally diversified portfolio tailored to a 30-year-old's long-term goals. Step 4. Execute in your brokerage account. This is where the rubber meets the road. Log into your brokerage account, whether that's with Fidelity, Vanguard, Charles Schwab, or another firm. Make sure you have cash deposited and ready to invest. Then, use the trade function to buy each of the 3 ETFs in the percentages you just calculated. If you're starting with a small amount of money, you might need to use a brokerage that allows for fractional shares, or just get as close to the percentages as you can. Don't stress about getting it perfect to the decimal point. Close enough is good enough, especially when you're starting. And finally, step 5. Maintain with set and forget discipline. The hardest part is officially over. Congratulations! Now, your job is simply to be patient and disciplined. The most important thing you can do is contribute consistently. Set up automatic monthly contributions from your bank account to your brokerage account. This puts your investing on autopilot. You should also consider rebalancing, though this is somewhat optional for beginners. Once a year, take a look at your portfolio. If the percentages have drifted too far from your target, for example, if a great year in the market pushed your stocks up to 85% instead of your target 80%, you can rebalance. This means selling a bit of the winner, in this case stocks, and using the money to buy more of the loser, bonds, to get back to your 80/20th target. This automatically enforces the buy low, sell high discipline. A really simple way for beginners to rebalance is just to add new money to whichever fund is below its target percentage. So, let's do a quick recap. The foundation: determine your time horizon and risk tolerance to set your stock and bond split. The blueprint: use the simple, powerful, and diversified 3-fund portfolio, which consists of US stocks, international stocks, and US bonds. And the assembly: calculate your percentages, buy the funds in your brokerage account, and maintain your discipline through consistent, automatic contributions. Listen, your first investment portfolio does not need to be perfect, it just needs to exist. The 3-fund portfolio is not the only way to invest, but it is a perfectly excellent way. It's a strategy that prevents analysis paralysis, it keeps your costs incredibly low, and it gives you a professional level of diversification right from day one. The most powerful step in any journey is always the first one. You now have the map, it's time to take that step. Thanks so much for watching. If you found this helpful, please give it a thumbs up and subscribe for more simple guides to building wealth. See you next time.